Every few years, a new technology shows up and the whole world splits in two. One half says it's going to change everything. The other half says it's going to end in tears, and both halves spend most of their time arguing with each other online, which means both halves are missing the thing that actually matters. Because the uncomfortable truth about the AI debate isn't that one side is right and the other is wrong. It's that both sides are arguing about the wrong question entirely. Everyone's been staring at the demand side, the users, the revenue, the adoption curves, the stories about how many people are using this stuff. But there's been something hiding in plain sight on the other side of the equation, a signal that has predicted almost every major financial bubble in history, and right now it's flashing louder than it ever has before. The number that unlocks all of this is $725 billion. That's what the biggest technology companies on Earth are on track to spend on artificial intelligence this year alone. Not revenue, not valuation, money going out the door, committed, deployed, gone. And once you understand what that number actually means, the whole debate looks completely different. There's a framework that serious investors have quietly used for more than 2 centuries to spot bubbles before they burst. It was documented by a financial historian named Edward Chancellor in a book called Capital Returns, and its central idea is deceptively simple. Everyone watches demand, the users, the growth, the revenue, the size of the prize. But demand is noisy and narrative-driven, and it can be faked. You can build a story about future demand that keeps a valuation floating almost indefinitely. Supply is different. Supply is just capital, committed upfront before anyone knows how the story ends. And you cannot fake it. When you stop watching the story and start following the capital flooding into an industry, its future becomes surprisingly readable. The pattern that emerges is so consistent across so many centuries and industries that it starts to feel less like a pattern and more like a law. So before we look at what that framework says about AI, let's watch it play out somewhere almost nobody thinks to look. Let's go back to somewhere most people have never thought about. Britain, 1761. An English nobleman called the Duke of Bridgewater needed to move coal from his mines in the north of England into the rapidly growing city of Manchester. Roads were slow and unreliable. Rivers didn't go where he needed them to go, so he built a canal. It was expensive, it was complicated, and almost nobody thought it would work. But when it opened, the price of coal in Manchester fell by roughly half almost overnight. The Duke's profits soared. For investors watching from the sidelines, this looked like the most obvious bet in the world. The technology was proven. The demand was real. The returns were extraordinary. And so the money came rushing in. By the early 1790s, what had started as a handful of sensible infrastructure projects had turned into something else entirely. Between 1791 and 1794, Parliament passed more than 80 separate acts authorizing new canals. In 1790, the total capital authorized for new canal projects was around £90,000. By 1793, that figure had risen to nearly £3 million in a single year. Capital poured in from every corner of society. Landowners, merchants, clergymen, shopkeepers, people who had never invested in anything before were buying shares in canal companies that hadn't finished a survey, routes that existed mainly on paper, projects that were held together by little more than optimism and momentum. Engineers who could design a canal became celebrities almost overnight. Shares in new projects would surge in value the moment a company was chartered, before a single spade had touched the ground. And then reality arrived, as it always does. Construction costs ran over budget. Revenues from tolls lagged far behind projections. Too many routes competed with each other for the same traffic, driving down prices for everyone. The mania was so intense it triggered a full banking crisis in 1793 when enthusiasm evaporated, and dozens of projects collapsed simultaneously. Many of the canals that were authorized were never finished. Most of those that were built earned a fraction of the returns investors had been promised. The people who funded the boom were largely destroyed by it. And yet, the canals themselves worked. The infrastructure that bankrupted its investors transformed the British economy for generations. The builders lost everything. The economy inherited everything they had built. That's the whole cycle in one story. Attractive returns pull capital in. Competitors pile in faster than demand can grow. All that new supply crushes the returns that attracted it. The people who funded the boom go bankrupt, and whoever shows up after the wreckage inherits the infrastructure for pennies. Chancellor called it the capital cycle, and once you've seen it once, you can't stop seeing it. That same cycle played out again in a completely different country, a completely different century, and a completely different industry. The United States, early 2000s. A decade of rising house prices had convinced almost everyone that property only went one way. Mortgage lending standards had been loosening for years. Banks were packaging up loans and selling them on in ways that made made the risk feel like it had disappeared, spreading it so thinly across so many different financial products that nobody was quite sure where it actually lived. And builders, responding to what looked like insatiable demand, were putting up new homes faster than at any point in American history. The supply signal was there for anyone applying the capital cycle lens. Housing starts were running far ahead of household formation. Inventory was building in market after market. The ratio of house prices to incomes and rents had stretched to levels with no historical precedent. At the peak of the cycle in 2005, the Bureau of Labor Statistics estimated that somewhere between 1.2 and 1.7 million construction jobs existed purely because of bubble-driven demand, work that wouldn't exist once the cycle turned. That's the supply-side signal made human. Not a chart, not a ratio. 1.5 million people whose employment depended on a building rate that couldn't be sustained. And then, as it always does, the supply caught up with the story. Prices peaked in 2006. By 2008, the financial system built on top of the housing boom was coming apart. The S&P 500 fell roughly 50% from peak to trough. More than 25 banks failed in 2008 alone. And by 2013, more than 500 had gone. U.S. household wealth fell by $16 trillion between 2007 and 2010. The people who had funded the supply, the builders, the lenders, the investors who believed the story, absorbed almost all of the losses. And the housing stock they left behind eventually became the foundation for the next cycle of growth. Different century, different technology, different country, different industry. Same cycle, same outcome. Which is what makes the current moment in artificial intelligence so worth examining carefully. Because the capital cycle signal that preceded both of those collapses is present right now in AI, and it may be larger in absolute terms than anything that has come before it. $725 billion in a single year. To put that number in any kind of human scale, if you spent $1 million every single day, starting from the birth of Christ, running through the fall of the Roman Empire, the Dark Ages, the Renaissance, the Industrial Revolution, both world wars, and every single day right up to this moment, you would still not have spent what the technology industry plans to commit to artificial intelligence in just this year. It breaks down to roughly $2 billion a day, $83 million an hour, about $23,000 every second. And critically, it's not slowing down. It's accelerating year on year. Now here's the question the capital cycle framework demands you ask about that number. Where is the revenue? Because supply without proportionate demand is the definition of what comes before a collapse. And the research firm Exponential View recently completed what they describe as the first serious bottom-up attempt to measure what the entire AI economy is actually earning. Not projected to earn, not potentially worth, but actually earning right now from real customers paying real money. Their figure for the trailing 12 months was $110 billion. That's the total revenue across the whole industry, from every company selling every AI product, against $725 billion going out the door in the same period. The gap between those two numbers is not a rounding error. It's not a temporary mismatch that will quietly resolve itself. It is the same supply-side signal that was visible in the British canal records of the 1790s and the U.S. housing construction data of 2005. Just larger than anything that has previously been recorded. What makes this particular cycle harder to read clearly is the nature of how the money moves. In canal mania, you could follow the capital in a straight line from investor to canal company to construction crew. The trail was visible and linear. In AI, the money moves in circles. The largest technology companies buy chips from Nvidia, which they use to build data centers, which they rent to AI companies, which use the compute to build models, which they sell subscriptions to, some of which come from the same large technology companies that bought the chips in the first place. The same capital makes several loops around the industry before it comes to rest anywhere. And every time it changes hands, somebody gets to book it as revenue. You can look at a chart of AI industry revenue and see explosive growth. What's harder to see is how much of that growth represents real end-user demand paying for something genuinely useful, and how much represents capital recycling through a loop and getting counted twice. Chancellor documented a similar pattern in the fiber optic bubble of the late 1990s, where equipment makers were lending their own customers the money to buy their gear and then recognizing those loans as revenue. It manufactured the appearance of booming demand out of capital that was essentially talking to itself. The industry looked healthier than it was right up until the moment it didn't. The AI version of this circular financing is more sophisticated and harder to map precisely, but the underlying mechanism may be similar. When you follow the arrows on a diagram of who is investing in whom and who is buying from whom across the major AI players, the loops close surprisingly quickly. This doesn't mean the demand is entirely manufactured. It means it may be harder to distinguish genuine end-user demand from capital circling the industry than the headline revenue numbers suggest. The other data point worth sitting with is what's happening inside the most watched company at the center of all of this. OpenAI's financials leaked earlier this year, giving the clearest public picture yet of what the AI boom looks like from the inside of its most prominent player. The company brought in around $13 billion in revenue last year, genuinely impressive growth, more than tripling from the year before. But its operating loss for the same period was around $21 billion. And in a detail that the capital cycle framework would predict almost exactly, the amount OpenAI spent on sales and marketing jumped by more than 400% in a single year, to somewhere around $5.7 billion. That's close to half its entire revenue spent just on keeping customers using the product. When a company has to spend that aggressively just to hold its position, it's a reasonable sign that competition has arrived and that the returns which originally attracted all this capital are already starting to compress. That's the capital cycle doing what it always does, on schedule, in the most visible company in the industry. The capital cycle also predicts something about timing, even if it can't predict a date. As more companies build AI products that are increasingly similar to each other, the cost of intelligence falls and pricing compresses. You can already see early signs of this, where capabilities that cost a significant amount per query a year ago now cost a fraction of that. Whether the wider correction resolves gradually over several years or sharply in a shorter period is genuinely impossible to predict from here. The capital cycle tells you the direction. It doesn't hand you a calendar. There's a phrase that gets used when people talk about how new markets develop over time. The pioneers get the arrows and the settlers get the land. The first companies into any new market do the expensive, dangerous, capital-intensive work of proving that the market exists. They absorb the regulatory battles, the failed experiments, the losses, the collapsed projects. And then the later arrivals walk in after the dust settles, inherit a proven market and a built-out infrastructure, and collect the value that the pioneers paid for. In the 1790s, the investors who funded the canal boom went bankrupt. The entrepreneurs who came after them inherited a transport network that had cost someone else a fortune to build. In the early 2000s, the housing developers and mortgage lenders who funded the property boom lost everything. The buyers who arrived after the crash picked up the same assets at a fraction of what they'd cost to build. The infrastructure of every technology era has been financed by the people who didn't survive it, and the people who got rich were the ones who showed up after the collapse with capital, patience, and a willingness to buy the wreckage at prices the market could no longer support. There's one more thing worth saying before we get to the question everyone actually wants answered. The capital cycle framework doesn't require you to believe that AI is a fraud, or that the technology doesn't work, or that the companies building it are being dishonest. Chancellor is explicit about this in Capital Returns. The biggest bubbles in history have almost always been built on real technology with real applications. Canals really did transform British industry. Fiber optic cable really did enable the modern internet. The question was never whether the technology would change the world. The question was whether the investors who funded it at peak capital flow prices would capture any of that value. The answer historically has usually been no. The value gets created. It just gets captured by someone other than the people who funded the original boom. None of this means AI isn't going to change the world. That's almost certainly not the right question. Canal mania was a financial disaster, and the canals were real. The fiber optic bubble destroyed trillions in investor wealth, and the internet that ran on top of it changed everything. The housing bubble wiped out $16 trillion of household wealth, and the homes built during it are still standing. The technology at the center of a bubble and the financial bubble built around it are two completely separate things, and history suggests the technology usually wins in the long run, even when the investors who funded it do not. What the capital cycle framework suggests, and this is the honest, careful framing, is not that AI will fail as a technology. It's that $725 billion a year flowing into an industry earning $110 billion in revenue is a supply-side signal with a recognizable historical shape. Whether it resolves gradually as revenue catches up, or sharply as it did in 1793 and 2008, is genuinely unknowable from here. What history suggests is that it resolves. It always has. The seeds of what comes next are already in the ground. The only question is who gets to do the harvesting.